So, our last speaker of the day is Steve Minar, Co-Portfolio Manager of the Rainmaker Fund. Steve has a focus on the international component of the fund as well as managing the overall fund. Steve, so good to have you in studio. Over to you, and we'll just chat a little bit after your presentation.
Okay, thanks for the opportunity. So we thought we'll take a slightly different tack this time and just talk about diversification. It's sometimes a term that's maybe overused or underappreciated, and let's just talk about that for the Rainmaker Fund specifically. The mandate was changed in the end of 2020 to be able to add some offshore stocks directly into the fund. So I thought it's worthwhile to say, well, what exactly does that mean in the portfolio itself? So the first slide, what I want to show you there is, we talk about what are we trying to do. So two quotes from two of the gurus in the industry, Warren Buffett and Bill Gross. So firstly, Warren Buffett says, well, if you do wide diversification, it's probably because you don't know what you're doing. Not that we want to say they're wrong, but we want to put it into perspective. So two questions I think we're trying to address today. One, why do you want to diversify? And how much is enough? Do you want to have 10 stocks, 20 stocks, 200 stocks? When do you have enough diversification? So the first chart there on the left-hand side, very simplistically, risk versus return, or return versus risk. You can take something like Coca-Cola, fairly low risk, but then you're probably going to get a fairly low return, although it's probably pretty certain over the longer term. But does it help you beat inflation? Maybe, maybe not. Then you get something like Microsoft, and I could have used a whole range of other companies there, where you have a higher risk of return, but you actually have a higher return itself. And somewhere in between is where you want to play with your portfolio and diversify between those two extremes. The chart on the right-hand side shows something that I think one need to keep in mind as well when you talk about diversification. When you invest in equities, there's systemic risk. It's hardly ever zero risk. There will always be some risk that you cannot diversify away. But if you look at the chart on the left-hand side, let's say you have a single stock, maximum risk, and then you take that systemic risk that you cannot diversify, plus the risk that you have in a particular stock. Let's say you have a particular mining company. If that commodity price falls, you're going to have a sort of a downside on that stock. But as you add more stocks to the right-hand side and you diversify your portfolio, you can diversify that stock-specific risk away to the point where ideally you only sit with a systemic risk. So let's look at a couple of indices that one can compare against. Now, I know this is quite a busy slide, and there's lots of little building blocks that you have there. Omri mentioned earlier today, I think he said 120 stocks. Let's call it 150 stocks. That's about the size of the market that you can invest in South Africa. We're quite light on industrials, healthcare, energy, and IT in South Africa. We're obviously over, sort of index on the commodity side. So it helps to be able to actually diversify into other markets as well. So what do those other markets look like? Well, you take the S&P 500 just as an example. On the left-hand side, then you get NASDAQ, which is obviously quite tech-heavy. You can see that big green block at the top. Then you get the Euro stocks. There you have a lot more, sort of staple companies. That's where all the beer brewers are sitting. Then you get the MSCI All World, which is sort of in the middle, and it gives you a very nice diversification. But how does that compare with the SA market? I have the All Share and then also the Capped All Share, and you can see very, very heavy on mining stocks and also financials, because those are the big sectors in the South African market. And then as a comparison, I said, well, what if you take a 30% offshore and 70% SA market, or a 45% offshore, as one is now allowed to do as of after the budget speech earlier in this year, and a 55% offshore. What does that look like? And immediately you can see that those two, 30 and the 45% offshore, looks a lot more diversified and a lot more balanced than what you would have if you only look at the all-share market on its own. So how does that compare with Rainmaker? As I mentioned earlier, we've had the capability to go up to 30% offshore, and as of beginning of the year, even up to 45% offshore. So again, on the left-hand side, I show you what the capped SWIX look like, a 30% offshore, 45% offshore, and then actually what Rainmaker looks like. So we have been building up to that 30% offshore position. We don't sit at the 45% as is allowed at the moment, but again, you have to look at the SA market. Specifically, you look at something like Naspers, British American Tobacco, Richemont, all the mining stocks. Those are SA stocks, but if you look at where they earn their money from, those are effectively offshore earners. So South Africa, we still have a substantial materials exposure, which again, that's part of the SA market. We've had great commodity price rises recently. And then consumer discretionary is also a pretty large portion of the SA market, again, because Naspers sits in that particular bucket. So in the Rainmaker Fund itself, we're sitting with about 28% offshore. In the SA market, it's almost evenly split, 16% into the mining stocks, 16% financials, 16% into the consumer stocks. Then you have the offshore component at 28, and then you have those stocks, as I mentioned, the British American Tobacco, the Naspers, and so forth, which are effectively offshore components. So it's almost 50-50 between South Africa and the offshore companies itself. What we do think differentiates and helps with the diversification in the fund is a 1.5% exposure to auto calls. I think we've explained that previously, but it gives you geared exposure to the stock, but it gives you the downside protection from where you actually enter that particular stock position. And that's a function of where we are at the moment, where you get very high dividend yields, very low interest rates offshore, and you can lock in that particular position and get the benefit over time. So what is the performance been like for the fund and for those different markets? Sorry, these slides have moved around a little bit. But if you look at it over the last 11 years, you want it to be just in the NASDAQ. I mean, that thing has just exploded. And you can see some of the other markets that have been doing, sort of less well than that, but still very substantial returns. Over the last 24 months, though, you look at the SA market, it's actually beaten all of those offshore markets, including the World Index, NASDAQ, S&P, and so forth. So these things move about over time. Then on the right-hand side, I show Rainmaker specifically. Over the last 3 months, you can see that the fund, yes, it's had a negative return, but it's fallen a lot less than the SA market or even a global a combination of a 30-70%. And if you look at it over 12 months, the fund has done better than the global market, it's done better than the SA market as well, or that 30-70% portfolio. So we do think that offshore diversification that we've built into the fund, as well as some of those auto calls, also now recently putting protection structures in some of the currencies, has actually helped the fund to get better performance. What I want to show on this slide, and again, I appreciate it's a bit busy, is on the left-hand side, the top 13 positions, which make up 57% of the fund. Going back to that quote by Bill Gross, that says, if you find a good idea, don't be shy to put some money at work. Nicole previously talked about the Naspers position, similar in our fund, fairly big position that's actually helped the fund over the last while with that announcement that they made. What I also show you here is a year ago and 2 years ago, so you can see the progression in those particular holdings. Those colored blocks, the light green that we have there, shows you the offshore positions. You can see 2 years ago, Q2 2020, we've had no direct offshore positions, and you can see how significantly that's crept into the portfolio to the point where even in the top 13, 3 of those positions are direct offshore funds, offshore holdings, the likes of Samsung, Visa, Google. Omri previously mentioned Google, how attractive that valuation is now. And then on the right-hand side, we show the next 16 positions that make up 27% of the fund. So if you add up these two blocks, I mean, that's over 80% of the fund. So relatively concentrated, yet still quite diversified. And there you see the likes of Shell. As a previous speaker also mentioned, we think a much better play on oil than necessarily, or energy, than necessarily through Sasol. Microsoft, well, L'Oreal, Thermo Fisher, great business that provides all the nuts and bolts to the pharmaceutical industry. You obviously know Amazon, Alibaba, and so forth. Li Ning, which is kind of the Nike of China. Martin Marietta, which is an aggregate company that operates in the US. And we think these are significant building blocks into the portfolio that can diversify the underlying business drivers that what we have in the fund itself. It's not just about buying something offshore because we can, it's about buying something that's got different drivers. So if something goes pear-shaped for, say, an MTN or a Glencore or a Sanlam, you have something like a Shell or a Microsoft or L'Oreal on the other side that's got very different drivers that can help you with the diversification. So 2 of those stocks, just to give an idea why we we like some of these stocks and why we think that diversifies the fund. So on the left-hand side, I show you a stock called AutoZone. Think of, say, there's a Midas in South Africa that sells, sort of the components that you use to service the car yourself, or wiper blades, or air filters, or these type of things. So in the US, we talk about a do-it-yourself market or a do-it-for-me market, where somebody will go and buy the oil and the filter and say everything else and say, please service the car for me. What people don't appreciate about the US is that their car park is on average 11 years old. Now, you would know an 11-year-old car requires some maintenance. And with their much heavier sort of winter weather conditions, the maintenance becomes even higher. During COVID, of course, people drove fewer miles because they work from home, but we can see that those miles driven has actually increased back to pre-COVID levels. We can see it in terms of the claims. We own an insurance company in the US as well, so the claims ratio started to pick up again. A lot of people seem to have forgotten how to drive during the work from home sessions. But that's very good for this type of business. The chart in the bottom left-hand side shows you the earnings expectations. It's sort of the yellowish and the brownish color for 1 year and 2 years. The red line is the share price. The green line there is the PE. And you can see how those earnings have grown significantly. This is a very good, steady compounder of earnings. The company is very cash generative. It sits with 16% of its market cap in cash, which we think is a great business. And this is the type of thing it will carry on for some time to come. Yes, the world is changing towards electric vehicles, but not everyone is going to be buying a new fairly expensive electric vehicle, and what it means is that car park of internal combustion engines will just age more and more and require more maintenance and provide more business for this type of business. On the right-hand side, I show you L'Oreal. It's a brand that you probably know fairly well on the cosmetics, fragrance, and beauty side. And then the top, those three sort of dials that you see there, a very well-diversified business. We've always liked this business, but it's been quite expensive because it's been such a uber-quality business. And you can see the chart in the bottom, very similar to the one on AutoZone that I showed you. The earnings have grown very consistently. And then sort of a year and a half ago, that share price started coming down. You can see the PE coming down quite a lot. Now, for us, that's a great opportunity to build a position in this firm. We didn't own it when it was that expensive. We just thought it's a great business, but everything has its price. And we kind of bided our time and then made the investment. It's well diversified. You can see geographically in terms of the divisions and also in terms of the categories that they serve, without getting into too much detail. Yes, people are concerned about consumers, the US consumer, global consumer, inflation, and so forth, but you might have heard of the so-called lipstick effect. So when you are under pressure and as a consumer, there's that sort of very simplistic view. It says, well, you go and buy something small like a lipstick. It makes you feel good. It's not as expensive as the really big luxury good items. Although if I look at my wife's cupboard, those lipsticks are quite expensive. Even so, they show there very specifically what has happened to lipstick sales. The US mass market, plus 26%. On the selective products they offer, 74% up. That is just in this year itself. Same in Europe, 36% and 77% up on some of the selective lipsticks that they sell. I know it's a small portion of the overall L'Oreal, but it's an example of a very well-run company that offers a product range that caters to a diversified consumer base around the world. And these are the type of businesses we think add great diversification to the portfolio. That's not just about NASPAS and Anglo-American and whether it's a Mr. Price or a Absa or a First Rand in the South African market. And that's my story around diversification. We think it is important that you do it. Don't overdo it. It doesn't help sitting with 500 stocks because then you spread yourself too thin. But we do think if you do it very selectively with a lot of forethought, and the ABAX way is to do bottom-up stock research, and that's exactly what we do for the offshore stocks as well, to build that portfolio that we think will give you a great diversified exposure to equities, not just in South Africa, but also on a global basis. And that's my story.
Thank you so much for that, Steve. I think you and my girlfriend have a good appreciation for L'Oreal. While you invest in it, she uses all of their products. You touched on a lot of individual stocks, yes, which we really appreciate. But I think in closing, it's very important for our listeners as well to just, if you can give us some nuggets, maybe the last 3 minutes on your investment process, especially on the global components of the fund.
I think it's important that we get that message across as well. So as ABAX, we see ourselves as fundamental bottom-up stock pickers. We're not macro research driven. We don't employ an economist or a macro strategist or anything like that. We like to understand the business, what drives that business, what creates value in that business that will create value for shareholders. Now, a great business isn't always a great investment, because you might find a great business. I showed you that L'Oreal as an example, that was just priced at a particular point where you say, yes, it's great, but it's just too expensive. And when you get the opportunity to invest at the right price, then it makes for a great investment. We have a great business. You can understand how they make their money. You can understand how they can grow the money. So we prefer to invest in companies that are growing their earnings. It's got a solid balance sheet, where they get all the metrics right. Then you want to invest in that type of business. We've been doing that in the South African market for many years, and now we're doing exactly the same process on the offshore side. So the skeptical question could be, well, how can you pick offshore stocks if you've only picked SA stocks? I think what people underestimate is the SA market, about 2/3 of the income of the SA market is actually offshore, whether it's mining companies, British American Tobacco, Richemont, and so forth. So having been analyst for those companies for many years, you've had to analyze the offshore competitors and peers in order to understand those businesses better. So when we started off investing offshore, it was now 9 years ago when we launched the first offshore product, you already had a ready base of stocks that you have analyzed over the years. You just couldn't invest in them. You can analyze Richemont and Louis Vuitton and all the other luxury goods. You just couldn't invest. Now we have the opportunity to do the same. Same from Sasol to Shell and so forth. Another component which I think is quite important, I mean, Omri previously mentioned some of the products and the derivative structures, autocalls and so forth, that they can, build into opportunity. And some of the other funds, Lara earlier talking about some of the fixed income, we operate as a team. So in Rainmaker, when we look at the currency, we get the input and we get the expertise from Lara and from Omri and from their teams as well, which, for instance, recently led us to put a protection structure on currency because the currency is blown out. So how do you do that? The autocalls, again, we use their expertise. So it's a great team effort that helps us to build the different products, but still based on that fundamental bottom-up research that we do for the building blocks.
Steve, thank you for that. No, it is definitely a team effort, and we see it coming out in the funds that you guys manage for us. So on that, thank you so much for coming today. We really appreciated your presence. Until next time.
It's a pleasure.
Thank you.
Thanks.